Hi traders, welcome to this edition of Expert Market Analysis brought to you by Errante. This is generally a bi-weekly review and preview, so every other week of the market's key events and trading opportunities. Whilst I'll just let you have a look at the disclaimers, I'll just run through what we hope to get through in the next 30 or 40 minutes or so, and also run through some of the key objectives of the webinar. Firstly, we think markets are generally driven by themes which buyers and sellers relate to in order to enter and exit markets. These can be stories or narratives which are long-term fundamentals, or perhaps short-term themes which increase and decrease in importance over time. We'll look to highlight those themes as we go through every other week for the webinar, and we'll just highlight key trade setups as well, all impacted by the main risk events of the week, and of course what's happened in the previous week, and also look at that price action and see how we can learn from that going forward. Our goal, I should say, is to break down all the market jargon and complexities that you read about. So if you do have any questions along the way, please do answer those, and I'll try and answer them as quickly as possible or at the end of the webinar. Okay, it's Wednesday, it's January 22nd, just after 11 a.m. in London. So let's get to it. We'll just, as I say, we'll just run through where markets are currently. We'll look at Trump, of course, the huge theme of the day, of the next few weeks and months, probably. And we'll just check out what's been happening with him, of course, with the inauguration on Monday and what's been happening since then, really. We'll then look at equities in more detail as well, with obviously earnings going on in the US. And we'll just have an observation really about some outperformance, actually underperformance of tech, outperformance of cyclicals in stocks, and just a few thoughts on that. Before then, just quickly then looking at US CPI data from last week, actually, and the impact that's had potentially going forward for the Fed. Before then, hopefully looking at a bit of UK data as well, and the impact on sterling against the dollar, also euro sterling as well, which is going higher. Before then, previewing the main event of this week, the Bank of Japan meeting on Friday, and we do have some PMI data out, and we'll look at the euro dollar whilst looking at Eurozone PMI data as well. So various different strands to look at and different areas, but certainly, of course, at the moment, Trump is all impacting the markets really at the moment, less so than probably most feared. Equities, they did rally on this idea of milder tariffs, basically. Oracle outperformed after Trump's announcement about a $100 billion AI infrastructure project. And then we also had Netflix results overnight. The stock was up around 13% after hours on record subscriber numbers. But Apple has fallen again, did fall yesterday over 3% on analyst downgrades, essentially on more competition and slumping iPhone sales, which reportedly fell more than 18% in the fourth quarter of last year. Hang Seng that fell on China tariff worries, and Asia was mixed really, with Japan up, with SoftBank up over 7.5%, I think, actually, enjoying that US AI initiative, but then China fell really on those trade policy tariff threats. Bitcoin just below record highs actually now from Monday. Those record highs at 109,358. Initially, there was some uncertainty really after Trump's executive orders, really not mentioning crypto very much, but then the pardoning of the Silk Road founder has been deemed as relatively positive. The dollar's been whippy, of course, with the executive orders really, and less tariff mention and trade policy mentions really, focus really on domestic issues, immigration, amongst environmental issues as well. Oil, that fell after tariff threats on Canada and Mexico. So we have seen those threats, although they have been informal and are literally only threats at the moment. Of course, that would or could kick off a sort of global tariff war, which would hurt growth. But then precious metals have prospered really since Monday in uncertainty. Well, along with all the uncertainty really, and gold is up to an 11-week high. We'll look at the gold chart shortly, actually. But yes, as I say, all eyes have been on Trump. Here we have this graphic actually from what we used actually on the 4th of November, or that week actually, during the election and after the election, and just what we thought would happen if we had a Trump presidency, a Republican House, and actually a Democrat Senate. But obviously, all those three are Republican, and this is kind of what we thought would happen with under that scenario. We've pretty much seen that since that time, so it's been pretty accurate, really. But yes, it's been about these executive orders. Rumors had been of up to 100 separate orders, including everything, of course, from tariffs to immigration to regulation and more. Just to put that into context, Biden signed 17 on day one and 37 in his first week. But yes, as I say, can't reiterate enough, all about tariffs really, and global equities have risen since the inauguration on Monday. We've had limited macro data, and earnings reports have been generally positive, so they've helped as well. But really, it's the idea that the sum of Trump's speeches and approximately around 50 executive orders have really been much less negative than feared. That's why we've seen equities really bounce quite nicely, of course, along with those other couple of factors, and then the dollar really sell off, even though we had the threat of tariffs on Canada and Mexico. Really, then it's a relief rally, and that may continue if Trump really refrains from making further threats, especially regarding tariffs directed at China and Europe. He mentioned overnight a 10% tariff against China, but that would still really be significantly lower than what consensus had anticipated. We kind of think the mixed signals actually from, well, what we've heard from news sources, of course, over the past few weeks as well, suggest there is at least some level of internal disagreement within the administration, within the Republican Party, really, over these various topics. Just remind ourselves that there were, of course, two schools of thought, really. Any announcements could be limited to targeted tariffs against specific countries and/or goods. Along with those immigration controls. But the other side would see broader universal tariffs announced at some later stage. Otherwise, the other school of thought basically was broad tariffs and universal tariffs straight away. And that would have hit, of course, the Canadian dollar, the Mexican peso very hard indeed, and the euro would probably underperform as well. We haven't seen that really. We've seen, well, much less mention of tariffs really, and a possible idea of phased in tariffs really. One that Scott Bessent, the Treasury Secretary, the new Treasury Secretary, has floated really that idea of starting with tariffs at low levels, chiefly using them as a negotiation tactic, and promising to ratchet up those tariffs higher from that low starting point. And if you remember the article, just mentioning about sort of 2% or 5% higher a month until the desired policies change from the counterparty had been made. Yeah, that's kind of where we are at the moment then. All eyes, all ears still on any of Trump's ideas, any of Trump's thoughts to journalists, and any specific policies which then are followed through with. At the moment, that's not really happened. So we've had this relief rally. Just for your guide again, betting markets actually had China priced at a 57% chance of tariffs in the first week, Mexico 61%, Canada 37%, and Europe just 8%. That was just before the inauguration. So really, it was the idea again of going hard on day one, or slightly less hard, of course, and more phased in tariffs. And that's what we've basically got, is the latter. Just want to then check out some of these currencies then that we said we would, and also gold. If I just pull up firstly, well, the gold chart actually, Really nice technical breakout really from this long-term triangle wedge and a breakout there around the sort of minor fib level. That was at 26.69. That's of this move higher. That's the retracement level there, and we've just broken out as well, held up above it, and then broke out of this triangle pattern, sort of long-term bullish consolidation really, and we have broken quite nicely again out of a minor, very minor sort of pennant flag pattern as well. That's a very short-term pattern around 2700, and there you can just see the breakout yesterday, and then today we're pushing higher as well. Very likely it would seem to us with this bullish momentum to take us up towards 2790, that record high, and potentially higher. For your guide, investment banks kind of quite a few were bullish, the majority bullish on gold actually for this year, sort of 3,000 target for some. Goldman Sachs, I know, originally put that out, but then sort of slightly backtracked and revised that 3,000 target. That was for year end really, on the fact that we may see less Fed rate cuts. But gold otherwise, obviously with this uncertainty, that is potentially good for the haven metal, of course. Obviously there is this issue around the Fed potentially not cutting rates as much. Of course, lower rates would support gold prices because it reduces the opportunity cost of holding a non-yielding asset like gold. A lot of people again cite the idea of gold being an inflation hedge, of course. We think that that isn't quite right really, and I know a lot of investment banks as well have done work on this and don't really see inflation, gold as a major hedge against inflation, just for your guide. Otherwise, of course, foreign policy decisions by Trump, particularly regarding China, geopolitical issues around that, of course, could heighten global tensions going forward, although, of course, Trump says he has been instrumental in the Gaza ceasefire, and then of course Ukraine, well, he mentioned, or he has backtracked on that actually, with stopping that war from day one, but then saying it could take as long as 6 months. He said that in the last couple of weeks. But yeah, technical breakout, really sort of textbook technical breakout by gold, and really 2790 is a target for bulls and beyond that as well. Just on other currencies, on those ones which were meant to be severely impacted, so we got the dollar against the Mexican peso. If we just pull it back here, you can just see here's the peso, and this is the weekly chart. So we've got sort of resistance around 21 or so, just below there. And interestingly, on the week, of course, so Trump's inauguration week, quite symbolic, really, that the dollar sold off, so the peso has gained, really a relief that tariffs have only been mentioned in passing, really, and not as a major executive order at the moment. Of course, this is. So it still looks precarious. We've got the 21-day moving average in that at 2051. We're just holding on to that as support. Otherwise, then we've got the swing low around 2005. Dollar CAD is probably more important and more traded by everyone. You can just see again a lot of consolidation around 144. The longer that goes on, then the bigger the breakout will be. So it's kind of 143 up to sort of 144.50. Obviously yesterday, on mention of Canada and Mexico, we popped up to 145.16, but then really interesting price action, barely closed higher on the day after that big move lower on Monday when Canada wasn't expressly mentioned. So very whippy, as you can see, price action on the daily. But really, yes, we need to break then that recent low 142.60, and potentially we could see 142 pretty quickly after this sort of sideways trading over a number of weeks. So that's gold and the main currencies which are potentially going to be affected. We'll look at euro dollar shortly, and also sterling against the dollar and the DXY chart when we look at inflation. yeah, just before we leave that, of course. So just touching on Canada and Mexico, obviously there was a threat of 25% tariffs. But then both those loonie and the peso are trading stronger, as I've mentioned, compared to Friday at least. That really, just to re-emphasize again, a signal that markets still reluctant to price in the full extent of the tariff impact, and really perhaps still hanging on to hopes that tariffs will be delayed further on the back of some cooperation on migration. If you remember, especially for Canada, Trump really threatening tariffs because of the impact of immigration and drugs coming through the border. But any chart that you look at just shows that Canada especially has very, very little, 0.1% and less going through the Canadian border. So yes, interesting idea, of course, and Canada have threatened their own policies, tariffs back on Trump. So we will see what happens, but it is a very volatile, precarious situation at the moment, for sure. Just looking at equities then, if I just pull up firstly, this is the S&P daily chart, and of course we have earnings at the moment. Which are here, and you can see the S&P, S&P chart here. So mega bank, just going on earnings now. Major banks obviously kicked off earnings last week. Profits at some of the biggest US lenders were seen rising really as deal making picked up and trading was boosted by strong equity markets, of course. Overall, the S&P 500 companies are expected to post a 10.4% increase in fourth quarter earnings from the same period from the same period from last year. That's according to LSAG IBES data as of January 15. Actually, just before we look at the S&P, I'll just show you a quick chart of that actually, which is here. So yeah, 10.4% increase expected in earnings across the board. That's the average. And we have had, as I say, Netflix, that's ramped up 13-14% overnight in the grey market after smashing subscriber estimates. We do get Johnson & Johnson and Procter & Gamble today as well, so they'll be checked out. Major drug company, of course, and product maker, consumer staples company, really, Procter & Gamble. So yes, they will be watched quite closely. Otherwise, just go back to charts, and the S&P 500 really had a great week last week, actually, not their best week actually since Trump's election victory week. Again, boosted by those strong bank earnings and that softening underlying inflation data really, which raised the chances of further interest rate cuts by the Fed this year. There was also that geopolitical improvement, of course, with the Gaza ceasefire. So the S&P that closed up 1% last Friday, actually leaving the index up nearly 3% on the week. You can see here. So really negating those losses from the start of the year. It was actually its best weekly gain since the 4.7% increase in the 5 sessions to November 8th, when, of course, Trump was elected. Won the election, of course, and raised hopes that we would see tax cuts and deregulation, and that would really boost corporate American, which is what potentially we will get. The tech, just looking at the technicals then, sure, certainly we've got the all-time high, of course, it's just below 6,100, and with the bullish momentum, really looks like we will get there quite soon. Comes after, you can just see that doji candle on Friday, just sort of denoting indecision before then this big move higher. Nasdaq, which we have here, again just pushing up off the sort of well, near the 100-day moving average, actually at 20,500. We pushed up above to 21,500 and above that. Obviously, all-time high is at 22,133. And the Nasdaq, well, it enjoyed its best week last week, actually, since early December. Just the observation around this, and if we look at the Dow, you can see that big push from sort of 42,000 and the 38.2 retrace level of this move higher. From the low, yeah, back in January, actually. So, yeah, January low last year up to the high in December. Then we had those sort of multi-year record consecutive losses, 10 I think there were, and then we stabilized around that 38.2 level, so 42,000 just above there, and then we pushed off through the next fib level, through the 100-day moving average and the 21-day, and looking pretty good. The observation really we had was that cyclical stocks really, which are the Dow, which incorporated in the Dow, really, they've led the way over the last few weeks, and they've led the way for Europe as well, which has really seen US counterparts significantly underperform, despite, of course, the relatively supportive data we've seen from the US. And Europe has actually outperformed the US this year, which is not what you would imagine, obviously, from last year especially. And it's really this sort of notable lackluster really has been appetite for high value global tech stocks, especially in the US. Tech has been the second worst performing sector year to date, up till Friday at least. And with, of course, tech and growth dominating markets last year and in 2023, just quite an interesting trend to kick off this year, of course. Fatigue potentially, and really investors realizing that the premium perhaps on US tech growth, and specifically, of course, the Mag 7, possibly being seen as unjustifiably high, of course, and there could be potentially then room for adjustment. A lot will hang, of course, on the earnings coming up, with Microsoft, Tesla, and Meta all reporting this time next week, actually Wednesday after the close, US close next Wednesday, 29th. We have Apple next Thursday after the close on the 30th. And then the following week, we have Google and Amazon. So, yeah, they will be key earnings reports for the indices and really for stock market, stock markets, of course, in general. Just something I just want to also mention about that theme as well is the fact that, yes, at the moment, the Mag 7 is trading at a 100% premium to the S&P equal weight. Just to remind you, it has been the other way around. So sort of around 15 years ago, the equal weight was actually trading at a 10% premium to the cap weighted index. So just something to highlight there for you, and a theme that we have been looking at. Okay, let's get on to just last week's main risk event was US inflation data, and that helped, of course, US equity indices go higher, as we mentioned. Firstly, yeah, here's a graphic with the main numbers. Came close to expectations, but details continue to show easing underlying inflation. So the core, that slowed to 0.2, or is that actually 0.225 to 3 decimal places. And that came after 4 consecutive 0.3% prints, with the year-on-year at 3.2. Headline, that came in at 0.39% month-on-month, so rounded up to 0.4. That was above the 0.3 consensus, actually, and was due to rising energy and food prices. But the core details, those are the key ones for the Fed, and they were more encouraging. So shelter inflation, which takes up a big portion of the CPI basket, that slowed after November's hotel price surge, and both rental and owner-occupied housing inflation are cooling, and printing at 0.3% month-on-month, which is much more in line with long-run trends. and really points to ongoing normalization. As I say, they are given high weights in the CPI basket, so really a major factor to look at. We did see hot prices in new and used vehicles again, but core goods and healthcare prices were also easing as well. Just to remind you, of course, we need to see 0.17% prints in the core month-on-month readings really to be confident that the annual rate of core inflation is on a path to 2%. That means we're kind of still too hot, of course, and it means a Fed pause, of course, going forward. But sort of longer term trends potentially are more optimistic that inflation will potentially fall going forward. The data then, it sort of improved the bets on Fed rate cuts for this year. There were just around 30 basis points of cuts priced in before the numbers last week. And now we see above sort of 40 basis points priced in for the whole of this year. That means the first rate cut probably doesn't come till June at the moment, but that was before the data priced in around September. Okay, we'll look at the dollar index chart now, which is the dollar against 6 of its main trading partners. Interesting, of course, we have moved up from the September lows around 10% to the recent high from mid-Jan. Yeah, 10% move in the trade-weighted dollar since September then, and that goes with the surge in yields of around 100 basis points since September as well. That's although pulled back really, but has offered really quite serious headwinds to growth with mortgage rates actually are back above 7%, and credit card borrowing costs as well remaining near all-time highs. That should act as a headwind, as I say, to growth, and also should dampen inflationary pressures as well. And you can just see now that dollar index has sort of pulled back from that strong rally of near 10% since those lows in September. We're now over a percent lower off those recent highs. And you could just see, well, we've got this sort of ascending bull channel, series of higher highs, higher lows, and we've just sort of, depends where you put obviously the lower bands, but we've sort of broken down through that, and we've just got some fib levels in here from those lows in October, September, up to that high, and we're just nestling on that 23.6 minor retracement level, really, that is, at 107.81. We've got these dotted lines in here from the high from October 2023, that's at 107.34, and then we've got the highs from April and May last year around 106.51. That kind of then tallies with the 38.2 retrace at 106.34. That is if we go lower, but they potentially should act as support as well. Much, of course, depends on Trump, tariffs, and trade policy. And he is set to speak actually via Zoom, I think, so virtually with leaders at the World Economic Forum at Davos tomorrow, I think. So watch out for that on the wires. Okay, otherwise, let's move on to, well, here's a chart with just some of the core CPI data and the core PCE data. Then just before we get to that, we'll just talk about UK data now as well. And we'll look at cable. Let me just find the chart, apologies. Which is here, and we'll just extend that nice downward trend line, which should act as resistance potentially that you can see it has previously. Just going to pull it back to some long-term fib levels, which you can see there on the weekly, which is there. So this is cable, so sterling against the dollar, of course. We had inflation data as well out of the UK last week. Same time, same day actually, not same time, same day as the US data. And December for inflation for December actually surprised significantly to the downside. So the headline that printed 2.5% versus 2.6 consensus and expected, but the core that fell or rose at 3.2%, but that was 0.2 below consensus and 0.3 below the prior 3.5%. Services inflation, key number for the MPC, that rose at 4.4%. Consensus was actually for 4.8%, and the prior was 5%. So much lower than expected, and also the BOE's expectations, which were for 4.7%. So downside surprise, kind of broad-based as well. Important numbers for sterling and for the Bank of England. Services, of course, by far the most important component, as I say, and that was interesting. And really other measures of core services as well, which exclude volatile components such as airfares, they continue to decline and show easing momentum, which is all good news, of course, for the MPC if they want to cut rates in February. Of course, with the lower than expected US data, inflation data as well on the same day, it also offered much needed relief actually to UK markets, UK gilt markets, after the recent sell-off in gilts and the surge in gilt yields. We also had jobs data actually on Tuesday, yesterday. That was mixed actually. We had the biggest 1 month decline in the number of employees since November 2021, and actually the year-on-year change falling below zero was the first time since April 2021. But then wage growth, well, excluding bonuses, was actually slightly higher than expected. The month-on-month increase, though, in private sector pay, which is probably what the Bank of England look closely at, that was more subdued. So yeah, UK, you've got the weekly chart here. You can see a long-term fib level around 122.59. We've just sort of went below that, but bounced off it. We didn't get to 120.37, which was the lows from October 2023. If we look at the daily chart, then you can just see sort of support around 122, with that fib level at, where did we say, 122.59. We're above that now, and we're also above that cycle low, swing low from April last year. That's at 122.99. So interesting sort of big zone of support, 122 area, and then above that 123 is that cycle low. If we hold around here, then obviously we've got this downward trend line and the 21-day moving average. That's that blue line, the blue line at 123.76. And then that downward trend line probably comes in where around 124, just above that. So we need to break that decisively, really, you would say, to stop this continuation of this long-term downtrend. And then, of course, 122 area is strong support with that recent swing low just below 121. You can just see there. So that's cable. I said we'd look at euro sterling as well. Really big bounce being seen here. We didn't quite get to that long-term low, just above 82. If I just put it back, you can see that from March 2022. We did have that swing low from April 2022 around 82. Where are we? 82.49 or so. We got just below there, kind of double bottom, and then we bounced since. And also through that level from August 2022 at 83.39. Strong bounce through that, and now we're just through the 200-day moving average at 84.21. This is euro against the sterling, and potentially then we need to break above Monday's high at 84.73 for more upside. Of course, a lot depends on now the moving gilts, and if I just look at the 10-year gilt yield, this is, you can just see that spike higher above 480, and now we're just moving lower. That of course helps the UK government, of course, but things don't look that great for sterling generally, you have to say, because really to resolve the risk of breaching the fiscal rule, the government really either needs to cut spending and or the Bank of England cut rates, and that would of course lower gilt yields, or of course both will happen. The odds of a 25 basis point rate cut in February, 6th of February, the Bank of England meeting, they have risen sharply with this softer CPI data now, and that is pretty much nailed on now. 25 basis point cut in February. And that's what we've been seeing with sterling going lower against other currencies, but obviously doing better against the dollar more recently because of dollar weakness, essentially. Okay, let's get to this week's main event, which is, of course, the Bank of Japan meeting. That is on Friday. Markets pretty much price in a 25 basis point rate hike, which would take rates to 0.5%. There's around an 80% chance of that happening, I think, at the moment, according to money markets. If they go with that, then the Bank of Japan will have raised its policy rate by 60 basis points in total since March of last year, when it started off at negative 0.1%. Remember, that means really the kind of steer away from NERP, negative interest rates, really is well underway now, you have to say. The hike is partly because of higher wage growth, which has become entrenched in Japan, and core inflation shows continued progress really to the Bank of Japan's inflation goals. And there are expectations again, which point to a third strong yearly gain to the spring Shunto round of wage negotiations. Of course, all eyes still on Trump as well, and whether he imposes global tariffs, especially on Japan as well. And then if the Japanese government retaliates, then that may further reinforce imported price pressures, and hence further raising of policy may be needed. We haven't seen it yet, so at the moment, yes, a 25 basis point hike is very likely on Friday. Of course, we have heard from leading Bank of Japan officials as well, which have hinted at a move recently, and the odds of the hike actually doubled really since, well, in the last week actually, after we heard from both Governor Ueda and Deputy Governor Himino, formally really declaring this meeting a live one, and that really is a signal for a likelihood of a rate hike, of course, barring any disruptive effects from Trump, which we haven't seen. The Bank of Japan will also release its outlook report containing board members' median forecast for real GDP and core CPI, and officials are said to be mulling upgrading their inflation forecasts, although, of course, this wouldn't be much of a surprise given the acceleration in the latest nationwide core CPI reading. That rose to 2.7 from 2.6% expected and 2.3% previously. Just to note, we do get an update to that core nationwide number a few hours before the Bank of Japan meeting, and again, it's expected to have ticked higher actually to 3% in December from that 2.7% in November, mainly due to the end of the government's energy subsidy program, while exports are expected to pick up, which is potentially front loading ahead of the possible Trump tariffs. You can see that all here with core CPI picking up, obviously, and the policy rate potentially as well, going higher again from that negative 0.1 reading we had last March. If we just look at dollar yen, actually, let me just pull up that chart, which is here. You can just see, yeah, some fib levels I've drawn in here from this move lower. Minor fib level around 157.16. We got up to 158.87. It's all kind of intervention territory around here. 158 to 160 really. Kind of consensus for intervention zone possibilities by the Japanese authorities. So we sort of hung around there, and then we've moved lower since the middle of last week, actually, when the rate hike idea was put into markets after Ueda and Himino spoke last week, as I say. So odds of a hike doubled, and the yen has strengthened since that time. Yeah, resistance above around obviously 157 region with that high at 158.87. Otherwise, that recent low from yesterday, actually 154.76. We need to break that then to see probably 153.40 with the 200-day moving average, that black line at 152.78. Okay, just briefly, we'll touch on PMI data actually, which we get also on Friday. The Eurozone PMI always watched by markets. Probably like to show a very small pickup in manufacturing, and the services possibly indicating more modest growth. Still above 50 though, 51.5 versus 51.6 previously. Then that means the composite will likely move around that 50 mark, which separates obviously expansion and contraction. There's headwinds continue with business concerns, obviously around tariffs, and we do get speech is from ECB President Lagarde, actually from Davos, probably Thursday, I think, as well. The market prices in around 100 basis points of ECB easing this year. Just with euro dollar, similar to sterling, actually, you can see long-term bear channel really breaking down below 102, that spike low to 101.76, but we just sort of formed a base around here, and we picked up obviously on Monday that big move higher, breaking above 104, and we've still got this level from October of 2023 at 104.48, sort of long-term low there. So we need to break above that really to break out of this long-term channel. If I was to put a channel on here, actually, yeah, you can just see we're just kind of breaking out now. If we touch these 2 points here, yeah, interesting. Yeah, just coming up to that 104.48 level. In euro dollar, so need to break that to really break out of this long-term downtrend. Otherwise, sort of 102 area just above that. 103 is strong support. Okay, we'll wrap it up there. Thank you so much for being on the webinar. Really appreciate you tuning in, of course. And yes, we'll be back in a couple of weeks' time with well, it'll be a review certainly of next week's main events, which include, of course, the Fed and the ECB meeting. ECB expected to cut, Fed expected to hold. We also have that series, that slew of mega cap tech earnings as well next week, so we'll review those as well. And as I mentioned, we do get Google and Amazon the following week, so we'll check those out and probably look at the specific stocks as well and price action in those. Okay, take care out there. It's going to be volatile with, of course, Trump, but some trading opportunities, no doubt, and we will speak to you in a couple of weeks.